Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. And welcome to the Deep Dive. We're here to cut through the noise, really figure out what's shaping our financial world. Today, it's a pretty packed agenda. We're diving into global markets, what's happening in corporate boardrooms, economic policy shifts. We've pulled insights from, the usual suspects, Reuters, Yahoo Finance, CNBC, to give you the full picture. Our mission today, it's really about connecting the dots between policy, how consumers are behaving, what companies are doing, see how it all fits together, uncover that why behind the headlines. Okay, let's kick off with the big picture. Geopolitics, markets, starting with the U.S. tariff saga. It feels like this story just keeps going. We saw that federal appeals court ruling against some key trade policies, but the administration is pushing back hard, aren't they? What's the long game here? Is it just this legal fight?
Right. And what's truly fascinating, if you look at the filings Bloomberg reported on this, CNBC too, is just how fast the president moved. President Trump's gone straight to the Supreme Court, wants a quick review of those lower court decisions that said, most of his global tariffs were illegal. This isn't just some minor legal tiff. The stakes are incredibly high. We're talking trillions in trade. And a loss for the administration. While Bloomberg Economics crunched the numbers, it could slash the average U.S. tariff rate in half.
Half, wow.
Yeah, and potentially force the U.S. to refund tens of billions of dollars already collected. That's huge.
So more than just the money, it could mess up existing deals too.
Exactly. Reuters pointed out it could totally upend preliminary trade deals. Think about the ripple effect across global business. It's massive. And the legal background, CNBC and Bloomberg detailed this, that appeals court ruling was pretty decisive, 7-4. A strong majority saying the president basically overstepped his authority using that old 1977 law, the IEPA, for these big import taxes. The court's line is clear. Tariffs belong to Congress, not the president.
And the administration wants this sorted fast.
Super fast. Pushing for arguments in early November, a decision by year-end. Much quicker than usual. They're arguing, according to CNBC, that delays could cause massive disruption, especially with, $1 trillion in tariffs already collected.
So $1 trillion.
Yeah. So the long game, it's really about defining or maybe redefining the president's power in global trade. The implications are enormous, lasting for any business operating internationally.
And it's not happening in a bubble, right? We're seeing reactions elsewhere.
Oh, absolutely. It's all connected. If we link this out, China just responded. New anti-dumping tariffs on U.S. optical fiber imports, effective today, September 4th.
Today.
Yeah. Followed a 6-month investigation. Bloomberg reported on it. They found U.S. companies like Corning, OFS Fattel, Draka Communications, basically circumventing existing rules. So the new duties are pretty steep, ranging from 33.3% up to 78.2%. It's a clear signal.
A signal about what exactly?
Well, CNBC quoted analysts like Evercore ISI's Neo Wang. He sees it as China's direct response to the U.S. pulling that waiver for Chinese chip supplies. It's like a reminder, Washington needs to maintain mutual trust, as he put it. And Stephen Olson from ICS Yusof Ishak Institute, he basically said it's just another sign of how complex and difficult doing business globally is becoming. It really highlights that tit-for-tat dynamic, makes the supply chain feel like a minefield sometimes.
Okay, but amidst all this friction, you mentioned something about auto tariffs, U.S. and Japan.
Yeah.
Any good news there?
Yes, actually. A bit of positive news on that front, specifically for the car industry. Reuters is reporting Japan and the U.S. are, in the final stages of a deal, lowering tariffs on Japanese auto imports.
Really? How much lower?
It could drop from the current 27.5% down to 15%, maybe by the end of this month, apparently via a presidential executive order.
50%? Okay,
So
that's significant.
it is, and it's part of a broader package. Japan expanding U.S. rice imports, buying U.S.-made aircraft, that kind of thing. It shows a different approach in some areas, right? More negotiation, trying to find mutual benefits, which kind of contrasts with the bigger tariff fights.
Right. So all this policy talk, it inevitably leads us to the Federal Reserve. Questions about its independence. And our sources link this directly to what's happening in the bond markets. What's the core concern? Why is this particular Fed nomination getting so much attention?
Precisely. And it raises that really crucial question about central bank independence. Today, Stephen Marin, who, helped design the president's tariff policy, he's up for confirmation. Senate Banking Committee hearing for a Fed governor spot. Yahoo Finance covered this.
The tariff architect going to the thought, oh, okay, I see the potential issue.
Exactly. He's pledged to uphold Fed independence, but Democrats, especially Senator Warren, are raising big concerns, given his past role and also the recent very contested firing of Fed Governor Lisa Cook.
So it's the political connection that's worrying people.
It's more than that now. The real insight isn't just that politics might influence the Fed. It's that the market is actively starting to price in that risk, quantify it.
How so?
Well, the why it matters here is pretty profound. Bloomberg and CNBC have highlighted this. This politicization, or even the perception of it, is directly driving investor behavior. Goldman Sachs even put out a note suggesting gold could rally towards $5,000 an ounce if Fed independence really took a hit.
5,000. Wow.
Yeah.
Because of inflation fears.
Higher inflation, yeah, and also an erosion of the dollar status. It's like a fundamental rethink of what a safe haven asset even is. People are questioning institutional stability itself. We're already seeing it in the bond markets.
Right. You mentioned yields were up.
Yeah, U.S. 30-year Treasury yields nudged over 5% this week. Japan's 30-year bond yield hit a record high. A lot of that is investor unease with where fiscal and monetary policy are headed. These long-term yields signal real doubts about future economic stability driven by inflation fears and those fiscal concerns.
Okay, so shifting from these huge global policy currents, let's pivot to how companies are actually dealing with all this and what it tells us about us, the consumers. You mentioned a surprise win in retail. American Eagle stock soared. But is this just a one-off celebrity-fueled thing, or is there something deeper, especially when other retailers seem to be struggling with spending?
That's a great question. And yeah, it's a fascinating story from Reuters. American Eagle stock jumped nearly 23% in pre-market yesterday. A lot of it seems down to those big ad campaigns. Sydney Sweeney, Travis Kelce, apparently their Great Jeans campaign specifically brought in unprecedented new customer acquisition. That's according to their CMO.
So star power still works, even now.
It seems so, for them at least. But the deeper insight isn't just that celebrities sell clothes. It's how a brand that really gets its audience and invests heavily in that kind of aspirational marketing can still win, even when overall spending is tight. It shows this widening gap, maybe, between brands that connect and those that don't. Michael Ashley Schulman at Running Point Capital Advisors called it a victory lap.
But he also added a note of caution.
He did. Said it also bakes in a lot of faith that this celebrity buzz lasts through the holidays. They are expecting comparable sales to rise a bit, low single digits, which is better than the decline analysts expected. So it's a calculated risk that paid off, for now anyway.
Okay, so that's one end. What about the other end? Where are people really cutting back if they need to? How are they dealing with the uncertainty?
Well, Yahoo Finance points us straight to the dollar stores, Dollar Tree, Dollar General. Both saw sales growth last quarter. And here's the interesting part. A lot of that growth came from higher income shoppers, people making over $100,000 a year.
Really? Higher earners go into dollar stores?
Yeah. At Dollar Tree, these shoppers were 2/3 of their new customer acquisitions in Q2. That's up from half in Q1. So it's not just the usual low-income demographic trying to stretch pennies. It's a sign that even wealthier consumers are feeling the uncertainty, reconsidering habits, prioritizing savings.
I'm like a barometer for the overall mood then.
Exactly. It shows this broader belt tightening across the board. The desire to save is just paramount right now. Dollar stores are almost a proxy for the psychological impact of these economic headwinds. But there's nuance, too. Dollar General's CEO Todd Vasos noted that while their core lower-income customers are spending more despite feeling worse about the economy, they're also getting hit by challenges like tariffs pushing up costs and a softening job market. So growth, yes, but it's a complex picture. Consumers under pressure from multiple angles.
Okay, let's switch gears. Let's dive into tech. Apple's got a big announcement coming, but maybe some challenges too. And Huawei's making moves in China. What's the buzz?
Indeed. Yahoo Finance has the details on Apple's fall event next week. The big launch is expected to be the iPhone 17 Air, supposedly about 2 millimeters thinner than current models.
Thinner is good, usually. But any trade-offs?
Potentially, yes. It might only have one main camera, unlike the multi-camera setups on other models. And a skinnier phone could mean, a smaller battery.
Battery life. Yeah. Always a concern.
Right.
And prices.
Analysts are projecting hikes, maybe $50 to $100 across the new iPhone 17 line.
So what are the expectations? Big upgrade cycle.
Depends who you ask, really, which tells you something about consumer priorities right now. Gene Munster at Deepwater Asset Management, he sees a solid cycle, thinks 80% of sales will be people upgrading older phones, like going from an iPhone 13 to a 17.
Yeah, that sounds positive.
But then you have others like Wamsi Mohan at BofA Global Research or Brandon Nispel at KeyBank. They're a bit more cautious. They're questioning if just being thinner is enough to really excite people, especially if you compromise on the camera or battery.
Right.
And they also wonder if maybe maybe some demand got pulled forward earlier in the year because of tariffs, which could hurt sales later on, especially in China, which is obviously a huge market.
Speaking of China, that brings us to Huawei. Their market share growth there, especially in foldables, seems really impressive given the sanctions they faced. But how much is that purely innovation versus, say, a buy local push in China? Is it a true global benchmark?
That's a really important distinction to make. CNBC reported on their latest launch, the second-gen trifold phone, the Mate XTs. Pricey, starts around $2,520. It runs their own HarmonyOS 5.1, designed to keep their momentum going in China, and the numbers are impressive. They're now the biggest smartphone vendor there, 18% share, and they dominate foldables, 75% market share, according to Counterpoint and IDC.
75%. Wow.
Yeah. So clearly, they have innovated. They found ways around those U.S. sanctions, cutting them off from chips and software. But your point is spot on. A big chunk of that success is definitely boosted by strong domestic support in China, partly as a reaction to those sanctions. So while the innovation's real, the market conditions driving that dominance are pretty unique to China.
Right. And sticking with chips,
Mm-hmm.
that U.S.-China tension is still playing out heavily with NVIDIA, isn't it? Seems like despite political pressure, demand for those AI chips is just off the charts.
Absolutely. This is where geopolitics really hits the tech market directly. Reuters had sources saying that even though Beijing is apparently discouraging purchases,
Right.
big Chinese tech firms like Alibaba and ByteDance are still very keen on NVIDIA's AI chips.
Even the restricted ones.
They're closely watching the H20 model. That's the one NVIDIA got permission to sell again in China. And they're even interested in the potentially much stronger B38 chip. Could be 6 times more powerful than the H20, maybe double the price.
So NVIDIA's caught in the middle.
Completely. It's a complex dilemma.
Yeah.
The U.S. backed off some of the really severe restrictions. NVIDIA argued, look, it's better they use our chips than let rivals like Huawei completely take over the Chinese market.
Makes sense from their perspective.
But China is still pushing hard to become self-sufficient in chips. Authorities have apparently been questioning companies about buying the H20, citing information risks. So it's not just about sales figures. It's a strategic battle over tech leadership. And NVIDIA's had to make some unusual moves, like agreeing to give the U.S. government 15% of its H20 revenue. That's quite a concession.
15%. Yeah, that shows the pressure. Okay, staying with tech, but shifting focus slightly. Innovation, especially AI applied to data, seems key right now. There was news about a data security IPO backed by NVIDIA. That seems to fit the trend.
That's right, yeah. CNBC reported on Cohesity, they're a data security firm, and they're apparently looking at a potential IPO in 2026, aiming for a valuation similar to or maybe even better than their competitor Rubrik, which is valued around $17 billion.
And NVIDIA's involved.
Directly. NVIDIA invested in Cohesity back in 2024. It happened after Cohesity launched this AI-powered search product called Gaia. What Gaia does, essentially, is turn all that backed-up data companies have, which usually just sits there, into a valuable asset you can use for AI.
Ah, making backup data useful. Interesting.
Exactly. Apparently, the idea came from talks with NVIDIA's CEO Jensen Huang and Microsoft's Satya Nadella. It helped position Cohesity as a leader in data protection, especially after a big merger they did. It really signals where things are going. The next big value driver in tech seems to be using AI to not just store data, but to secure it and make it actively intelligent, moving from passive storage to smart utility.
So while the giants fight over chips and market share and new innovators like Cohesity pop up, let's zoom out again. What do these wider market movements tell us? Any significant shifts in major indices or regulations reflecting these trends? And what about that dialogue between Washington and tech leaders?
Right. These individual company stories, they paint a picture of an economy really in transition. Looking at Europe today, markets were mixed. Stock 600 up a bit, France's CAC 40 down slightly, according to CNBC. But 2 index changes really caught my eye. Porsche, the luxury car maker, is set to drop out of Germany's main index, the DAX, on September 22nd.
Porsche out of the DAX.
Why? Well, their share price has been slumping for a while, attributed to things we've talked about. U.S. tariffs, weak demand in China, maybe a slower than hoped for shift to electric cars. They're being replaced by an online listings company, Scout24.
Interesting. A sign of the times, maybe? Old industry struggling, tech moving in?
Kind of feels like that, yeah. Almost a changing of the guard, signaling which sectors are seen as more future-proof right now. But then, on the flip side, look at Burberry, the British luxury fashion house. They're actually rejoining the UK's FTSE 100 index on the same day, September 22nd. They've been out for a year.
So comeback story there.
Seems like it. Suggests their big overhaul strategy is starting to pay off, even in a tough consumer market. shows that brand revitalization can work. And here in the U.S., there's a regulatory move. NASDAQ is proposing tougher listing rules for small Chinese companies wanting to go public here,
Suffer how?
requiring at least $25 million in the IPO itself. CNBC noted this aims to tackle those pump and dump schemes where stocks get hyped up and then dumped quickly, and other compliance worries with smaller foreign listings. It's policy shaping market access, responding to perceived risks.
And that dialogue between policymakers and tech. President Trump is hosting tech leaders tonight.
He is, yeah. CNBC and the Daily Open newsletter mentioned it. A dinner in the White House Rose Garden. About 24 big names.
Who's going?
People like Mark Zuckerberg from Meta, Tim Cook from Apple, Bill Gates, Sam Altman from OpenAI. Quite the guest list.
Anyone notably not there?
Well, Elon Musk apparently wasn't invited, according to Bloomberg, despite his past involvement and, making amends with Trump recently.
So what's the point of the dinner? Just optics.
Probably more than that. It really highlights the close but complicated relationship, as they put it, between the administration and big tech, especially around new stuff like AI. It's a key chance for direct talks, influencing future policy, future regulations, for an industry that's just so tied up with national interests and global power now.
Okay, let's bring it all back home. What's really driving the markets today? What should investors be watching? Seems like jobs data is front and center, especially for clues about the Fed.
A huge amount of focus on jobs, yes, especially for figuring out if or when the Fed might cut rates. Today, as CNBC's Daily Open mentioned, we're waiting for the ADP private payrolls number for August. The expectation is for a softer number, maybe around 75,000 jobs added. That's down from 104,000 last time.
And weekly claims, too.
Yep, weekly initial jobless claims are also due. Forecast is for a small rise. But really, all eyes are turning to Friday's big official jobs report. That's likely to set the tone for the market in the near term. It feels like the market's really on edge, waiting for this.
That CNBC headline summed it up, didn't it? The Fed may be ready to cut rates, but the job market's cutting deeper.
Exactly. This cooling off in the labor market is what the Fed wants to see before they feel comfortable easing policy. And there's definitely optimism building about a cut. The CME FedWatch tool, the one that tracks market expectations, it's showing something like a 96.6% chance of a rate cut at the Fed's September meeting. That's according to CNBC.
Almost baked in, then.
The market certainly thinks so. They are absolutely laser focused on these jobs numbers to confirm that view.
Okay, and the other hot topic, the bond market and gold's incredible run.
Yeah.
That shift away from bonds as the go-to safe haven, it feels significant, doesn't it? What's it really telling us?
It is significant, a really powerful signal, actually. CNBC and Bloomberg have been covering gold's record run hit a fresh high, $3,578.05 an ounce yesterday.
Just keeps going up.
And what it signifies, I think, is this fundamental rethinking of the traditional safe haven playbook. Investors are dumping bonds globally. Why? Concerns about government spending, fiscal excess, potential debt crises looming in places like Japan, France, the UK, and crucially, that politicization of monetary policy we talked about earlier.
So if you can't trust the Fed's independence,
Then gold starts looking very attractive. It's a physical asset. It can't be debased by government spending or political interference in the same way currency can. In these uncertain times, it's becoming the ultimate store of value for many, a tangible defense against political risk, reflecting this shifting trust in institutions. Remember that Goldman Sachs call for $5,000 gold if Fed independence really gets damaged. That's the kind of fear driving this.
right, beyond those big indicators, any specific sectors or stocks to watch today or tomorrow that illustrate these themes playing out?
Yeah, definitely. Looking back at yesterday, communication services had a great day, up almost 4%. Netflix, Paramount, Skydance, they're leading the pack year to date, according to CNBC. Suggests people are still spending on entertainment, even with other pressures.
But not all tech is flying.
No. Salesforce gave weak guidance, announced a big $20 billion share buyback, but the stock still fell over 5% after hours. Shows even strong tech names are immune to headwinds.
And chips.
Big one today is Broadcom reporting earnings after the bell. That'll be a key read on the whole semiconductor space, which is caught between that huge AI demand and all the geopolitical stuff.
What of energy?
Energy took a hit yesterday, down over 2%. Crude oil prices are actually down 11% year to date. OPEC Plus is meeting Sunday, considering adding more supply back to the market, so that whole supply-demand balance is in focus.
And consumer goods.
Constellation brands, they make Modelo, Coronas, they cut their guidance, stock hit a 52-week low. Another sign that consumers are pulling back on discretionary spending. So you see all these threads, right? Tech resilience in some areas, energy shifts, consumer caution. It's all part of that larger economic picture we've been discussing.
So what does this all mean? It really feels like we're in this incredibly dynamic phase. Everything from, celebrity ads and new phones to Supreme Court cases and Fed independence. It's all interconnected, a complex web.
That's exactly it. What really stands out is that constant tension between these high-level global policy choices, tariffs, central bank decisions, and how they actually hit the ground, affecting businesses, investor mood, consumer wallets, all of it. These forces are just constantly redrawing the map of where the opportunities are, where the challenges lie. It shows a world where politics and economics are just becoming more and more intertwined. You can't really separate them anymore.
And for you, our listener, hopefully this deep dive gives you a clearer snapshot of all these forces at play. Maybe a few aha moments to think about. Understanding these undercurrents really helps make sense of the day-to-day headlines. See that bigger picture.
Yeah, think about how these big macro trends and these smaller company stories might ripple out and affect your own world, your purchasing power, maybe your investment strategy. This interplay between political influence and market fundamentals. It's not just today's news story. It feels like a fundamental shift in how the global economy works. How do you navigate a future where geopolitics might drive markets just as much as earnings reports, and where trust in institutions becomes, well, a valuable commodity itself, something to mull over?
Definitely food for thought. Thank you for joining us for this deep dive into today's financial headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.